in this sort of great sea of uncertainty that always prevails in financial markets, at least we've removed one. We know what the size of the cut is, but to be honest, it's sort of slightly immaterial. Everybody knew they're going to cut, so the size of the cut isn't really that important in the overall scheme of things, and it's certainly not something we would position our portfolios around. It's a very short-term issue. That's for the gamblers and the speculators. What we look at is the sort of longer-term issues. But what I would say is this: that the start of a Fed easing cycle is a really very important time. It doesn't happen all that often. We've had a very steep and long tightening cycle, and it's a great tonic for markets. It would be an extraordinary cycle if this were to continue without markets actually performing pretty well, because we know what the Fed's plans are. I'll talk about that a little bit. So I come with a note of optimism about what this might mean. I know there's a lot in markets already and all that sort of stuff, but it would be a very extraordinary cycle. There are sort of caveats if there is a recession, or if there's some big geopolitical event, the sort of thing that Tanisha was talking about. That would obviously upset the apple cart a bit, but not probably for very long. So this is a big day. I think it's a really good day for markets and hopefully for our performance in the next year or two. We obviously look at things over the next couple of years or so, and that's the key thing for us. So that's what I want to focus on. I've got a few slides. Some of these slides, incidentally, I'm borrowing from the speakers, where they illustrate the point that I want to make, and some we've put in for ourselves. Didn't get time to put some of yours in, Tanisha, but this reference to them here. So the key factors that we think are going to influence markets and drive markets over the next year, well, it's the economy stupid. Inevitably, that's absolutely key. And the U.S. economy remains really very vital. I mean, it's what the U.S. economy does that really, really matters. I'll talk a little bit about other economies, but that's the key. And the question is soft or hard landing. It's then the Fed. Now they've started. How far will they go, and how fast will that be? That's pretty significant, but the cycle is underway. Great. Then the AI boom. There's been obviously there's been an extraordinary driver of markets over the past 12 or 18 months or so, without which markets wouldn't have done very much, quite frankly. And there's some concerns now about whether it's going to run out of steam. Valuations have got a bit high. Whether these huge investments that are being made by the hyperscalers will actually not produce results. So there are some concerns about that. We'll talk about that. Geopolitics, I think, is always going to be around. Tanisha mentioned that quite a lot, quite rightly, and that remains an issue. And then this sort of broader issue I describe as deficits, debt sustainability, and deleveraging. I'll explain that a little bit, but I'm thinking about, I guess there was a small thing recently, that yen carry trade that unwound pretty quickly when the yen had a sharp bounce. I don't think that was a particularly big systemic event, and it doesn't appear to be so. But there are other things that are pretty worrying. In particular, the size of fiscal deficits that most Western countries and others are running, and hence the size of sort of total debt to GDP, which is definitely an issue, and I think it'll come back to horn markets. So I'll go through those, and at the end I've got a slide too on some of the longer term issues that I think they seem to be almost sort of structural things that will definitely happen, but the impact they will have on markets is very difficult to judge. So I'll talk about some of those at the end. It won't take, hopefully, too long to get there. So the global economy has been much more resilient than we all thought over the past couple of years. Remember, we've had an incredibly long and tight monetary policy tightening cycle here, and yet economies have actually done pretty well. But there are some concerns now about the slowdown. You've heard about some of those. I'm just picking out here the manufacturing sector globally, which is basically in contractionary territory. These are purchasing managers' indices. If the lines are above that 50, then it suggests we're in expansionary territory. Below 50, it's contraction. And you can see what's happening here. There's quite a big contraction going on in some parts of global manufacturing. You might say, well, global manufacturing is not that big in the overall scheme of things. It's a very good lead indicator of where GDP goes. And this is a pretty serious recession in Europe, in particular. I mean, the German manufacturing industry, and it's a huge industry in Germany. It's the biggest in Europe by a mile. Is really tanking. It's suffering very badly. The auto industry is suffering particularly badly. We've had VW saying they're going to close down potentially a manufacturing capacity in Germany, unheard of. So these are very, very challenging times, and it's going to be tough out there for some time, I think. So there are some fears about this. It's not catastrophic. The US has been the leader in this. It's growing well, and as you can see from these numbers, the US is actually the dark blue line there. I think it is from memory. Am I right, Andrew? Yes. The dark blue line there. So they've held up pretty well. It's been helped by the CHIPS Act and this Inflation Reduction Act and all those sorts of things that have boosted spending. So it's not a big negative, but it's something that we will certainly be keeping an eye on. You want to see this thing stabilise. Then China, of course, which is the second largest economy in the world, is in deep malaise. We all know that. I thought this was a particularly good chart that came out of the JP Morgan number of charts. There's a lot of really good information in that, I thought. It shows this. So these are demand indicators. It shows the complete collapse in real estate fixed asset investment. Remember, the Chinese property development industry accounted for about a third of China's GDP. Absolutely huge. We all know how much leverage was involved. We've all read about that. Huge amount of leverage. When these things go pop, then it's really very painful. It's hit people's wealth. It's hit consumer confidence. It's damaged the economy generally. We also know from experience that coming through those sorts of property deflationary things is long and tough. And look what happened in Japan. Look what happened in the GFC. It was essentially a property crash in the United States. It takes a long time to unwind all of this sort of stuff, and that's what's happening in China. The only thing that's been growing in recent years there, as you can see, is public fixed asset investment. But China's got limited room for fiscal flexibility because it also has pretty high debts. So China's not going to be a great supporter here. And many years ago, in one of these think tanks, I said that China's growth rate would ultimately slip towards more sort of Western levels of 3% or so. And that's what we're in the process of doing. It's got some pretty big headwinds apart from this, but it will come through this. It doesn't mean to say there's no opportunities in China. There are some good opportunities because everybody's really sort of discarded the market as a place to invest. Well, that's often a time to be thinking seriously about it. But there's the confidence crisis. I'm not going to dwell too much on that. It's completely collapsed. You could argue it's possibly stabilising. Maybe we're through the worst. I suspect we are through the worst, but it's nevertheless it's been a big drag on growth. Then the EU has got all sorts of challenges. I've talked about the problems in the manufacturing industry, but the EU has big structural flaws, which I think will hold back growth. It's got a single currency without a full banking union. It has there's no EU fiscal policy in the EU. There's no appetite for it. There's certainly no appetite for debt mutualisation. The Germans simply wouldn't wear it. There's all sorts of headwinds from the way they regulate. They have a precautionary principle in terms of regulation, which seeks to eliminate risks ex ante, and they're talking about possible risks ex post. So what does that do? It stifles innovation, and you can see that several people during the course of the past day or so have referred to that, and there's no prospect of that changing. That is built into EU treaty, so it's a big problem for the EU, in my opinion, and always has been. So there's lots of headwinds for the EU. And this one here shows how much they're having to pay for power and gas compared with the US and China. It's just a huge premium. Obviously, Germany made a massive mistake in relying so heavily on Russian natural gas. About 40% of their energy sources came from Russia. That stopped pretty much overnight, and they're having to reposition. They closed down their nuclear industry as well, which was a catastrophic mistake. So they're having to import a lot of LNG, and it's going to be a struggle still. They've got ample supplies. It's not as if they're going to be short. Their storage levels are pretty high, but prices are, as you can see, structurally higher than China and the US. So who's going to win in manufacturing when you've got power prices at such a premium? Well, plainly the US and China. So the EU has a problem here. It's a long-term stagnant sort of growth story in my view. If they're going to grow at 1% per annum, which is broadly what the big forecasters, the ECB and European Commission are forecasting, then that's about it. The demographic problem there too, which I'll refer to a little bit later. The other thing that the Fed has been focusing on, and indeed I think what we're seeing here now with the Fed, is a shift towards the away from the inflation part of its mandate, where you've got to keep inflation at 2% or thereabouts, towards the maximum employment side of its mandate. And that's where the focus of the Fed has moved to. And in the dot plot that came out, the FOMC governors every 3 months produce their forecasts. It's called a dot plot of where they think employment and inflation is going to be. Basically what they've done is lower their inflation forecast for the coming year, increase their unemployment numbers for the coming year. So they see some slowdown, obviously, in the economy. And that's where their focus is now going to be. So I think they'll be seeing this labour market cooling. That's where they will want to cut rates further. And they've got plenty of room to do that. If this cools further, then they've got plenty of room to do that fairly obviously. This first chart here just shows the payrolls numbers, which have been steadily falling down. This is job creation. And I emphasize job creation because the economy is still creating jobs. This is not a recession that we're in at the moment. Clearly, the economy is still creating jobs, and we're not in anything like recessionary conditions. It sort of points towards a soft landing. It would be terrific if the Fed could engineer that. And Ravi said yesterday, what did they put on it? A 55% probability, I think it was, of a soft landing. I would put something higher than that. Clearly, you can't eliminate the risk of a recession. We've had 2 years of very tight monetary policy, but we've come through it pretty well, I think. And this doesn't suggest to me that the labour market is a big problem. And incidentally, you've got wages rising in real terms. As this chart shows here, unemployment has ticked up a little bit. That's the red line there, but it's still pretty low by historical standards. The grey line are the job vacancies. So job vacancies have been falling, but there are still more jobs available than there are people unemployed. So again, this is not in sort of recessionary territory here, and it explains why real wages are still growing. So the consumer is not badly off. They've spent quite a lot of savings, as Ravi was saying, but the consumer is actually still spending. So it's cooling, but it's not weak. And the Fed has never used this sort of recessionary terms or tough conditions for the labour market. It's simply referring to it cooling, which I think is important. Inflation expectations have actually come down. That's key for the Fed, of course. They look at these numbers pretty carefully. We've got 2-year and 10-year here. There's no problems there. So as I say, the Fed is able to move away from the concerns about inflation towards ensuring the maximum employment part of its mandate. This is a cycle where there's no real signs of stress. We had that sort of mini banking crisis. When was it now? March 2003. It was, wasn't it? 23. Yeah, when some of those secondary banks in the US with their exposure to commercial real estate got into some difficulties. But there's no real signs of stress, and I think this is a good indicator here. This is credit spreads for US investment grade, high yield bonds, and emerging market debt. These are pretty low by historical standards. When you're in stress periods, these spike, and there's no signs of that. So we've got companies they're in pretty good shape, generally speaking, well funded. Took the opportunity when rates were very low to fund themselves. So they're in pretty good shape. If we're entering a tougher period for the economy, we've got companies, and I think households too, banks definitely. We saw some very good numbers from, I think it was again JP Morgan on banks that showed us just how strong the banking sector is. No, it's a chap from Jupiter, Luca, thank you. I think that's a real positive, and again gives me confidence that we're going to come through this with a soft landing, which if you want to call it a central view, I think I'd make that a central view, but bearing in mind there's still a risk out there of a much sharper slowdown. This is the market's view of where interest rates are going to be across the three big central banks, US, ECB, and the Bank of England, end of this year and end of 25. I haven't updated this for what's happened today, but I don't think things have moved very much. When I looked earlier, have they at least not moved very much in terms of where the market thinks rates are going to be. So we've had 50 basis points of this in the US, but it's still saying that effectively we've got quite a lot more to come over the course of the next 12 months. The Fed themselves in that dot plot are telling us that there's going to be about 150 basis points of cuts between now and the end of 2025. And they've given this very clear signal, something that the ECB and the Bank of England has not. So there's some uncertainty about the pace at which they will cut rates, but cut rates they will. And I'm pretty confident they will do so in both the ECB. The Bank of England's meeting today. They may not today, but they will, because there is a slowdown in the economy, there is a slowdown in manufacturing, and the EU in particular, I think, needs to ease things. So we've got, I think now, Alex, the Fed and the market are pretty much aligned on where rates are going to be at the end of next year. And the Fed is sort of saying similar numbers to these. Yeah. But what they have done, incidentally, the Fed, they've slightly raised their sort of longer term expectation for where the neutral rate is going to be to 2.9%. So call it 3%, which is also pretty much aligned with where the market thinks it is. So what that's telling us is that in this cycle, rates are going to be coming down by about 2.5%, and then they'll sort of stabilize. So will it work out that way? Well, things happen. So, but to us, that looks like a pretty sensible outcome. They're not going to come back down to zero as they were for that long period post the GFC. And that wouldn't be a bad environment, I think, if they can do that and the economy chugs along at a couple of % or so. That would be a pretty good environment, I think, for financial markets generally. Turning to AI, I'm not going to dwell too much on this thing. I thought it was a brilliant presentation from Mark Baribeau, as ever. I've borrowed a couple of his slides. There isn't any doubt about the extent of this boom that's going on in AI. There might be some doubt about the extent to which there'll be a return on these huge investments that we're seeing. But the market is going to be absolutely huge. There might be some doubt about the speed at which companies adapt to it and use it to improve productivity, cut costs, and so on. But they're going to, and it's going to happen right across the world. Maybe with the exception of AI, if you believe Mark Baribeau. It's quite possible. And there is, of course, this massive investment boom going on at the moment that is dominated by the hyperscalers and dominated in the US. There is some activity going on in the UK and in Europe, much lower scale than the US. I often ask a question at our asset allocation meetings. So, guys, who do you think is going to win the AI boom? The US, which doesn't regulate it; the EU, which is going to kill it with regulations; the UK, which is following that direction, more innovative, or China, who's not going to allow it. It's pretty obvious that it's going to be won by the US. And you want to be there to some extent. Yes, valuations are high, so you need to be cautious about that. But as Mark Baribeau said, we've had the sort of first stage of this cycle, and maybe things pause a little bit here, consolidate, but there's going to be a lot more to come over the next several years. So you want to be in this thing. It's going to be a really, really big part of portfolios and economies. We're somewhat underweight these big stocks at the moment, and that's, I think, the right place to be because they are ahead of the game. Maybe discounting rather too much, but you don't want to be out of them completely, fairly obviously. Geopolitics, I thought Tanisha covered that comprehensively and very well, so I'm not going to make too many comments on that, but you could say there's a bit of a disconnect here with the oil price going down. You'd think that with wars in the Middle East, which could tip over into something pretty serious, problems with obviously energy supplies coming from Russia, that war potentially extending further. You'd sort of think that the oil price might have gone up and stayed up, but in fact it's been coming down. I think it's lower today than it was at the beginning of the year. That, of course, I think there's two things going on there. One, markets have decided that the two wars that are going on are basically going to be contained and not spread much sort of regionally or globally. I think that's a pretty good bet myself. I mean, nobody wants these wars to expand further, not even Russia. There's got to be some compromise where Ukraine will have to give up territory. It's going to be made slightly more difficult by the fact that Ukraine's invaded part of Russia. But ultimately, that's got to come. I don't think, there's all this threats of nuclear weapons being used and all the rest of it. I think that's actually, you just have to dismiss that. You have to assume it's not going to happen, because if it does, then all hell breaks loose, of course. But I think it's actually very unlikely, because everybody knows just how damaging that would be. So I sort of slightly dismiss that. And I do think, obviously, there's a risk that this Middle Eastern conflict could get a lot worse. But Iran, which is obviously the key player alongside Israel in all of this, doesn't look as if it's got the appetite for extending this further. It's not quite ready with its nuclear weapons for a start. And so I think I think we'll somehow be able to muddle through this thing. But obviously, it's risky. There's a very good reason why we carry gold in the portfolio, even though it's at an all-time high, as Alex was pointing out. It's been a wonderful sort of protective asset, a capital preserver in difficult times. I think it's the best performing asset class in our portfolios this year, about 25% or thereabouts. It's gone up a lot, but you want to keep some because gold has got that wonderful ability to preserve capital in really difficult times. And although there's a very low probability of this becoming a global event, it's not zero. Commercial real estate, nice little chart from JP Morgan, which showed where the problems are, which is in the secondary banks in the US, small banks in the US. They've got far too much exposure. I'm not too worried about this. There may be some casualties, but as we saw in the first round of problems back in March 2023, it was very quickly mopped up. Other big banks simply bought these banks that got into trouble. And remember, the big banks have got just massively strong balance sheets. This is nothing like what happened back in 2008. All these banks are really very well capitalized indeed. And it's a key point. It's a key point for this cycle that banks go into this more tricky period in really very good shape indeed. That makes me optimistic. It's when banks fail that you start to worry. I'm not worried about this in the case of the US. This is containable. It's not going to happen anywhere else. It's a specific US problem. You probably can't see these numbers. This is a JP Morgan chart. You won't see them from the back, but I just wanted to refer now to this thing, debt sustainability. I mean, the numbers here, these are EU numbers. They show, I can hardly see them on the screen myself actually, but they show fiscal deficit to GDP and debt to GDP. And you're looking here at numbers where the fiscal deficits, Italy, France, Belgium's quite small, doesn't really matter very much. Spain, three big economies there, are pretty big percentages of GDP, and it doesn't leave very much room for fiscal manoeuvre. And remember, the EU Stability Pact requires this deficit to be 3%. If it's above that, they've got to tighten. So it's almost a sort of counter-cyclical thing. But perhaps more importantly, look at the total debt to GDP. Italy, we know, has had big debts for quite a long time, 140% or thereabouts. France, 112, second biggest economy in the EU. Belgium, let's say it's pretty small, doesn't matter. Spain, 105%. If you add on then, the UK is running at about 100% debt to GDP, running a fiscal deficit of about 4.5%. The US, the most important economy in the world, I re-emphasize that, 7% fiscal deficit, running at 120% debt to GDP. Of course, the US has the exorbitant privilege of the world's reserve currency, so they're never going to worry about financing that, but it does provide a constraint on where they can go in terms of fiscal spending. This longer term, I think, is a headwind to growth because these debts can't go on like this. They have to be ultimately constrained, and there's only one way of doing it. It's either raising taxes or cut spending, and those obviously are going to hit growth. So I think this is a longer term worry. It's not. I don't think it's a systemic problem. As I say, there's no problems about the US in particular raising finance. The UK has its own currency; it can do that easily. More difficult in the EU, but I think we'll get through it. But it's a constraint on longer term. So those longer term structural issues I referred to earlier, de-globalization, that's obviously one. Sanisha talked about that, and I think that's now going to be a long term thing. Supply chains are definitely moving. Once you move them, you certainly move permanently. Question marks about whether these things are inflationary or deflationary. I suspect that's sort of probably tends to be somewhat inflationary, higher costs all around. The energy transition, lots of people involved in this whole process of climate change and all the rest of it tell us that it's going to result in lower energy prices. Well, maybe, but it's some way out. As the cost of this transition is going to be absolutely huge in terms of investments in electricity grids across the world. So I suspect this is likely to be somewhat inflationary over the course of the next few years. Demographics. Well, I've got a slide on that, but basically the Western world, China, Russia, their fertility rates are all some distance below, in some cases quite a long way below the rate required to maintain populations, which I think is about 2.1, 2.2. Thank you. And then there's the geopolitics, supply side shocks, which I've talked about a little bit But clearly that's a problem that's going to continue. This is not just the next 12 months or 2 years. So I just one or two slides on these. I'm not going to dwell on this one because Tanisha mentioned it, globalization retreat, trade policy interventions. Who thinks this is going to change after the election in the US? Well, nobody, because I think it's completely bilateral. The tariffs on China and protectionism on China, it's whether it's Trump or Kamala Harris, it's going to continue. So that I think is probably inflationary, as I say. I thought these couple of slides. See, these slides came out incidentally of an extremely good report written by Mario Draghi of "We'll do whatever it takes" fame to save the euro. Former central bank governor in the ECB. He produced a report on EU competitiveness. It came out last week. It's really worth a read. There's two versions. The 65-page one is the one to read. The other one's hundreds of pages, but it's really worth a read. It explains in very clear terms why the EU is failing economically and is growing at literally about 1% per annum. It also sets out solutions. Actually, Ravi referred to this JP Morgan yesterday in his comments as well. And he said, I wonder what's going to happen. Will they take it up? Well, I'll tell him what's going to happen. They simply won't implement these changes. Some of them they simply can't. They don't have the appetite for it. And some are actually constrained by the German constitution, amongst other things. But I'm afraid that's not a happy position for the EU. Anyway, these charts I think are a bit sobering. The extent of dependence on China for manufacturing capacity in clean tech is pretty sobering. So I don't have a solution to this, and I'm sure, given human ingenuity, we will find a solution. But you've got to say that you worry about being so heavily dependent on China, which has moved quite clearly to much more autocratic sort of way of life than we've seen since Mao, I guess, really, to be honest. So that I think is a concern, and I guess it's going to have to result in changes in the way that the Western world deals with this thing, and then the similarly concentration of extraction and processing critical resources. You can see there aren't many Western countries in those bar charts there. So these are big challenges. I don't think anybody currently has answers, but I'm sure people are thinking about it to see if there's some way that we can shift this processing and manufacturing. I mean, at the moment, China is dominating the production of solar panels around the world. Prices have collapsed. Electric vehicles, nobody can compete against them. But hence protectionism. The EU, of course, is a great protectionist body, and they're planning to whack tariffs on. We know the US is going to do that. Not a happy science situation. One nice chart, which also came out of that ECB report, incidentally, long-term population developments, China, the EU, and the US. I don't know how countries are going to deal with these sort of huge changes that are going on. Difficult to predict population sort of 100 years out, but over the next 20 or 30 years, it's pretty easy to predict, because particularly the working age population, because a lot of those people are alive now, you can count them. But more difficult a long time out. But the one thing I can say with pretty much near certainty with China is that they ain't going to get any immigration. Nobody wants to go and live there that isn't already living there. So that's for sure. And when you've had a one-child family policy for 2 generations, it creates some issues. And now they don't want to produce children at that rate. They can't afford it anyway, at the rate they used to do. So it's a massive problem. The Chinese population is going to halve by the end of this century. How do you cope with that? Be some cheap houses, Steph, for you to buy. A lot of them. And the EU is in the same position. Where's Lorenzo? Lorenzo, I think Italy is one of the worst demographics. Where is he? Oh, he's there. 1.3. So, Lorenzo, your country needs you. Stop practicing and get on with a proper job. Make babies. I'm too old. But it's a serious problem. How do you cope with these massive changes in demographics? Obviously, Europe's not going to stop immigration, neither is the UK. It might say it's going to, but it's not going to. So the EU will be bailed out to some degree by immigration from Africa, in particular, the Middle East. But the indigenous population is in decline. Let's hope we don't all die out. Won't happen in my lifetime. Anyway, it's not great for growth. I mean, remember the Chinese population surge was a huge tailwind to growth for all those years. Working age population is already falling. I think I'm right in saying that this year is the year when the actual population starts to fall. Well, imagine what that does to growth in the longer term. It just wipes out chunks of GDP. So that's a worry. I don't have an answer other than advise Lorenzo what to do. And then just a quick summary. I've covered most of these points, I think. So on inflation, the Fed's not worried about inflation anymore. It's moved towards target, close to target. It's pretty much the same across the EU and the UK. The UK's got a bigger inflationary problem because of wage rises. We've just handed out huge wage rises to the public sector, and that's going to be painful for a while. So I think the Bank of England might be slower than other places to cut rates. Might help sterling, incidentally. I think sterling might be performing pretty well when the US is cutting rates. The EU will cut rates. So here we are at this great turning point. As I said earlier, I think it's a really, really important day. It's a great tonic for markets, and it makes me pretty optimistic, subject to these caveats that I've mentioned. There is a little bit in the price. I accept that, but on the economic outlook, we talked about that. It's definitely slowing growth, but there's no systemic risks out there. The Fed is easing because inflation has come back to target. Not because there are great systemic crises out there, not because the financial conditions need loosening. They're basically saying that it's because the labour market is slowing. Their focus is on that, but the economy is still growing. So this is a really sort of nice position to be in for the Fed. It's a nice position to be in for financial markets. Well, the risks we've talked about, inflation could stay too high. That looks like a pretty low risk at the moment. High debt levels, I've talked about that, and that's difficult to judge, but it does remain a constraint to growth, I think. Policy overkill, where the Fed might have overkilled things, it might have been too late. Time will tell, but I wouldn't put a high probability on that. I think the Fed's done a great job, actually. And then at the moment, the corporate sector is doing pretty well. Profits are pretty good, but you could see a slowdown. Obviously, if there's a recession, it would hit profits hard, and that would change things for a short period of time. But clearly, if the economy slows dramatically into negative territory growth, then the Fed's going to ease dramatically. It's got plenty of room. The rates are still 5%, remember, or thereabouts. Yeah, it's 5%, isn't it? Yeah. So they're still very high in real terms. And of course, the rates have gone up and inflation has come down, then real rates have gone that much higher. So they've got plenty of room to cut. Geopolitics, there to me is a reason for keeping diversification in portfolios really absolutely vital. We haven't talked about the US election. The only thing I would say about that is that, I know as much as you do who's going to win this thing. My gut tells me it will be Trump. It's down to literally a handful of states. We all know that. But the big thing is what will happen afterwards. I think it's much more predictable than 8 years ago when Trump got in. First of all, Kamala Harris is going to essentially follow the Biden policies. So you can tick the box there, whether you like it or not. That's what it is. And then Trump, he's obviously extremely unpredictable and will remain the same, but I think he's got a much better team around him. If you remember, in those first few weeks and months after his first term started, it was just completely chaos in the administration. There was coming and going. It was just like a revolving door, quite literally, all over the place. I think he's got a much better team around him this time. He's better prepared, and he's somewhat more predictable. We know in terms of fiscal policy, he's going to continue to spend. So there's no cutting back of the fiscal deficit for the foreseeable future. It may grow somewhat slightly slower, but do I think the election is going to be a market-moving event? Probably not. Probably not, would be my guess. I wouldn't want to bet on it. What's the final one? Oh, well, the US-China relationship has sort of largely broken down anyway, so could it get any worse? Well, possibly, but I think we all know the issues there. So we're in this sort of pattern now where markets have discounted quite a lot. Alex referred to that. There's some parts of the market that are expensive. I was persuaded by Mark Barabo's case that the AI to mega cap tech stocks are highly rated, but if you look at where profits are going to be over the course of the next few years, they're not too bad. So again, you want to be underweighted, but you don't want have no exposure there. This boom is going to be going on for quite some time. Definitely, we're seeing a more broadly based equity market move at the moment, and I think that's going to continue. I was intrigued by the fact that Baribo wouldn't normally be expecting to buying housing stocks in the US. He bought a couple of housing stocks to take advantage of this turn in the cycle that's coming. I thought that was pretty intriguing. When a growth manager broadens out into housing stocks, then you know there's something going on. So I think broadening out portfolios is a very sensible thing to do. Don't put all your money into a growth basket, but keep some there. And then what's the final thing I say? Oh, yes. I think it's going to be a better environment for active managers, which, Alex, I know you talked about over a period of time here. And I think there's a pretty good case for saying that, because clearly passive managers have given you a full exposure to the mega cap tech stocks. If they start to underperform, which we have been seeing, and I think might well continue, then you're going to get more pain there. And I think it's a time to being in active management rather than passive. But overall, if we look a year from now, I'd be pretty surprised if markets were not up. But clearly there are going to be bumps on their way. We may even get bumps in the very short term because there's quite a lot discounted. And we're certainly going to get volatility. There'll be disappointments for a Fed meeting or whatever. There'll be some geopolitical issue that comes along. And incidentally, some of those sort of issues that I've talked about, those longer-term structural sort of issues, central banks have no control over that. So it introduces uncertainty and volatility, and we're going to get some of that as we go through the next year or so. So you've got to keep diversified. You just don't want to put your eggs in one basket. Keep some gold, definitely. But basically what we're looking for now are periods of opportunity where we can add to risk assets and indeed add to some of the stocks, some of the bonds that we've been talking about. You know, those CoCos, AT1s that Luca talked about, getting yields of 7-8%. That looks to us pretty interesting. So if you get opportunities to buy into these things, if markets have a setback, then that's what we should be doing. So with that, I'm going to stop. If I'm happy to take questions if there are any. Otherwise, I'm going to hand over to Andrew just to sort of round off.